Hi guys, welcome to my gold video. I know a lot of you know that I trade gold regularly. You would have seen me place a lot of entries and sells and buys, etc. on this particular commodity. I really enjoy trading gold, especially when it lines up where I'd like it to line up. Now, one thing that I've found with gold is out of everything else, such as fibs, trend lines, etc., this pair really likes previous market structure. Now, although I obviously use previous market structure with all my other breakdowns, a lot of my other breakdowns are more based on higher lows, higher highs, trend lines, etc. Now, although I will be using trend lines on this particular pair, one of the main things that I do use with gold is support and resistance, which is obviously previous market structure. So right now we've got gold sat on a bar replay around the 7th of November. Now we can see that we had this huge sell-off from the highs of around 1360, 1350. Massive sell-off. And the thing is with gold is once it goes, it goes. Honestly, it just takes off. Now it's a really nice pair to trade because technically it just respects levels so nicely. Now another thing that I use with my gold when I'm trading gold is I use silver as a correlation. So it's almost one of my little technique secrets as such of how I can determine where gold is going to go next. Now the reason why I know this is because generally silver will do the move most of the time before gold does it. So if you're a little bit uncertain about gold and where it's going to go next and which levels it's going to go next, you simply just have to look at silver and see where that's going. And if there's nothing between two zones on that particular pair, then you know that gold's got a little bit further to go. Now I'm going to show you some examples of that today. Now normally with my breakdowns is I do a bar replay all the way through, but because we're going back to almost like the 5th of October, November time, I'm not going to do that on this particular pair. So what we're going to do is I'm just going to show you how accurate these levels are. So let's just zoom right out. Now, if we're looking at previous price here, and we're looking back as far as sort of the beginning of January in 2017, the first level that I would have plotted on this particular chart would be somewhere around here, probably this wick here. So I probably would have gone in at around sort of 11.8 to 50, something like that. Now we can see how well it respects because we would have known on this sell-off, we would have had these levels plotted to help us figure out where price was going to stop and continue and reverse. So we can see that gold eventually came down to the sort of 1180 area and found some sort of support around this previous. Now, obviously if we'd have continued, then the next zone would have been around here, right? Around 11.25. It's as simple as that with gold. Honestly, it's so simple. There's no magic here whatsoever. So the next level for me would have probably been something like, let's make sure this is nice and tight, maybe even 11.2650. Perfect. So that probably would have been my next level. Now it likes to stick to 50s, 25s, that kind of thing. Now we've got to bear in mind with gold is that if, for example, it says 3450 pips, we simply have to take the zero off it. So let me just show an example of that. Is basically if we use the measuring tool and we go from here to here, you can see that the number there says 3773, but that's actually 377. So some people get a little bit scared and intimidated by trading gold. That's simply because it seems like it's a lot of pips, but it's not. We just have to simply remove the last digit off to allow us to get a more realistic pip count. So that would be my first level at 11.8250. And obviously, like I said, if this had broke, I would expect that if it had taken out this most previous bottom, that we would then come down further. So let's go up a bit further on our next level. So the next one I would probably put in would be on this wick here, which is around 11.97. Let's call it 50. Let's see how that fits. That fits nice and snug. Okay. Now the next level I'd put on this would be just to simply go up to the next one, which would be here. So that would probably be something like 12. Let's see. You have to play around with it and get a nice snug fit. So this would probably be my next level. Now my next level above this would be the next wick, obviously. So It seems like it's too simple, like what I'm doing is too simple, but gold is very simple to trade. That fits lovely. Now the next level I'd probably put on this, maybe something like that. That fits really nicely. Maybe 12.9550, because we've got this mark here and this mark here, and then we've respected it all here. And then let's see if we've got any others here. So we've got 12.3750, 12.1225, 11.9750, 11.8250. I would probably put another one maybe here. Let's see how that fits. 13.04. And then maybe another one around here. Because you can see we respected it here and then here. So they're probably the levels that I'd go through. So we've got 11.8250, we've got 11.9750, 12.1225, 12.3750. We've probably got one as well. Yes, we've got the 12.9550, the 13.04 and the 13.22. Other than that, the rest of the levels, you know, there might be one here. You've probably got one around here as well, which is the 12.65 kind of area. So we could put that in as well. Let's see how that fits. Let's see how that fits. 12.65. Now this looks like a lot of lines, and obviously you wouldn't have maybe all these lines on here right now just because price is here. You probably just have like the next two to clean up your chart. And so what I'm going to do now is I'm just going to show you with this on a bar replay just how much gold would have respected it. So you would have had these levels in at this point. Okay, so this is how well price respects. Let's just watch what happens. Let's just speed it up nice and quickly. Respected. Respected. Broke through. Retested. Respected. Broke through. Retested. Respected. Broke through, respected, broke through, respected. Broke through. And then price stopped. Respected, respected. Retested. Okay, so we can see how well prices respected these levels. So at this point, we rolled down, respected this level, came up, retested, came up, struggled, popped up, retested, came up to the next level, broke through, retested, came up, respected, 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 came down, flew through, came up to this one, respected, came down, formed this new level here, broke through all the way down. And then we've also got like an intraday level that we would have had at this point here. Okay, we would have had another level around this kind of region here, which would have been around sort of 1280. But let's get onto that shortly. Let's get onto that later. Now, the simple fact is that if we just do a bar replay back to where we were, so let's just go back to sort of here. Now, it's really, really simple with gold. What you would have basically done is the moment you have 2 points, like I've said to you guys before, you would have drawn a trend line like this. Okay? Simple. Now, when price came down like this, what's the first thing that we know that we can do to this? We put a fib on it. Very, very, very simple. Now, we can quite clearly see from this wick to this wick here that the 78.6 lines up beautifully with market structure and the ascending trend line. So therefore we'd be getting 1, 2, third touch around the 78.6. We know it's not probably going to be these ones because there's more confluences here. Okay? Now another thing that we can do once we have the 2 points at the top is we can simply apply our next trend line here. So now we're in a channel up. Can you see how easy this is to trade? tap, buy. So we would have bought it here, and then because we would have bought it here, we'd be anticipating for price to come up to this kind of region here, and hopefully take out this most recent higher high. So you can see we respected this level here, came up to the next level. Now if we broke this, we know that we're coming higher. Retest. Now at this point here, you can see that at one point we respected it. So therefore, really, to be honest with you, if we had have traded this long position here, obviously, like I've taught you guys, this is on the daily time frame, right? So therefore, we would have had to scale in once we figured out that this was an area of interest. So when price had got here, and then it was coming back down, we would have known already that this was an area of interest here. Okay, let me just change that blue because I really don't like that. Perfect. So therefore, when it got here, we would have scaled down because this is the daily time frame. So we would have scaled down to the 4 hour, the 1 hour, and begin looking for rejection. So you would have got a much entry in that, a much better entry. I'm not going to show you that because it's obvious. It's what I've taught you in the other breakdowns. But basically what you would have waited for was a 4 hour. I mean, this is one daily candle. So imagine how many 4 hour candles that is. You would have waited for a better rejection, say got in here. Put stops below, say 40 pips. And you would be targeting, obviously, the minus 27%. So that trade in itself is a 1 to 15. Very basic confluences. We've got a third touch of an ascending trend line, market structure on 78.6, creating higher lows and higher highs, anticipating the third touch for execution, because we know it's an 80% probability. Now, when that would be our first trade, and that is 608 pips. You can see it here, look, but obviously we removed the last digit. And same with this. So let's remove that. So that would be our first trade. Now, when price broke this channel and then retested it, can you see this retest here? When price broke that, we can quite clearly see that we're going a lot higher. Now, the likeliness is that once we've broken this zone, we're just going to go to the next zone. Now, this is not how I normally trade. I don't just trade between zones because it seems far too easy just to say, okay, if it breaks 130, we're going to 135. If it breaks 135, we're going to 140. It seems too basic, but with gold, it really is that simple. It really is. So once we break this, we know that we're coming up to this level next. Now, once price begins to do something like this, instantly, I'm beginning to think to myself, could I potentially draw some sort of trend line on this? Something like this. Maybe. Let's see how it plays out. Respected the level again. We come down. Now, when I'm looking at this, can I fib this? Could I have seen that this was going to happen? Well, let's have a quick look and see if it was a fib. It doesn't matter if it wasn't because we know we've got market structure. So yeah, it was. Fantastic. So therefore, before this had even happened, when price had stopped at this structure, the first thing that I teach you guys to do when price stops is to attach a fib. Now we would have gone from this point to the point where it stopped. And we can quite clearly see that the area of interest in this case would have either been here, because we've got the 61.8 and we've got previous market structure, or alternatively around the 50%. But this definitely would have been an area of interest. So with that being said, obviously we're on the daily and you guys know that we always scale down. We never just go off a daily or a 4 hour. We always scale down to the smaller time frames. And in fact, what I can also do with this is I can duplicate this and suddenly we're beginning to look like we're in a bit of a channel. And this makes our life a hell of a lot easier because we can simply just trade between this channel. Okay, so this would have been a great execution point. So let's just see how this played out and see which fib level it actually respected. Okay, we can see we're bouncing around the 50%. And we're bouncing around this market structure here, okay, which is the 1304 level. Okay, so therefore, in this scenario, when we would have scaled down, in fact, I'm going to scale down now to show you exactly how we could have got a much better entry on this. So just bear with me. We're going to scale down to this exact point here. Okay, so this is now the 4 hour zoomed in. So to be honest with you, once we came down and tapped this 50% here, we could have simply just gone straight off this 4 hour candle here and made sure our stops were just below. Now that is quite a large stop. Now how can we get around that? How can we get around the fact that this is quite a large stop? Simple. We just scale in again. So now let's scale into the 1 hour. Okay, so this is the 1 hour. And this is also 50% tap, which is obviously the channel up, the trend line to the channel up. Now, if you look at this, because we've got these multiple rejections, 1, 2, and 3, and now we've perfectly hit the ascending trend line and the 50%, we would therefore be looking to go long straight off this candlestick here. And I'd make sure that my stop is below this most recent level and below the trend line. Okay, so therefore I could get away with basically putting a 50 pip stop on this particular trade. Something like that to give us enough breathing room. Now for targets, let's zoom out and find our targets for this particular trade because it'd be easier to see it on a higher time frame. Okay, so this is the 4 hour again. Now, with regards to targets, you can quite clearly see that we've got a much better entry on the hourly candlestick as opposed to waiting for this 4 hour candle here which engulfed the previous. So this is why once we've highlighted an area of interest, which in this scenario was the 50%, which it was always really going to be the 50% because price never just drops like that. It's quite rare. Normally you'll find if price is quite slow and it's just trickling like this to the right hand side, it's likely it's going to come down to the 50%. And obviously the 60% is below the trend line. Let's just remove this, neaten things up a little bit. Now, targets, if we're coming off the 38.2, the 618, the 50, the 786, it's always take some profit off at 0% just in case it creates a double top. So therefore, in which case this would be a 1 to 4.3. And then obviously, if we broke the 0%, our main target would be the minus 27%. So therefore, this trade would be a 1 to 7. We'd be risking 50 pips to gain 352 pips because obviously we remove the 8 off this number here. And that would be our next trade. Okay, so let's see how this plays out. So at this point our trade was met. Now we can see what happened here is that we basically came down once again. If we just tighten this up, we can quite clearly see that we came down and rejected this upper trend line and the kind of area of minus 27%. Now on this particular occasion it's unlikely we're going to come up to here. The reason being is because we've got this ascending trend line that for months has been protecting price. So when we see this rejection here on the 4 hour, instantly I'd be thinking to myself, right, now I want to short it back down. Now, like I've talked to you guys before, the first thing that we do when price stops is we attach a fib, right? So this is a signal to me that price is beginning to stop. So therefore I would put my fib like this. Now again, if price just drops like this, then I'd be looking for this with 61.8. But we do have an option where price could trickle. If it trickles like this, then we might hit the 38.2. Very similar to what happened here. We trickled, we ranged left to right. So I already know that I'm looking, depending on how fast price moves, for this kind of region here. This is the kind of area of interest that I have to potentially buy this and take it further long, back up to here and provide myself with another touch of this ascending trend line to then short it, buy it, short it, etc. until basically this breaks, this structure breaks. Okay, so now because I've got this on the 4 hour, I would now be looking for entries to short this. So therefore I'd have to now scale in. So let's scale in and see if we can find some entries on the 1 hour and see if there's any candlestick formations that suggest to us that this would place a good short. Okay, so here's the 1 hour. Now we can quite clearly see, it's so obvious, that we actually have an entry straight here. So this would have already been an area of interest because it was the minus 27% and it was another touch of this channel trend line. So therefore we would have already had this on our radar as price was approaching. Now when it got here and then suddenly formed this this bearish engulfing candlestick, to be honest with you, you could have pretty much gone short straight off this point here. And made sure that your stops allowed price enough space to breathe. Something like this. Okay, now we don't need to question and wonder and look through all these different, smallest time frames. We know what our target is. It's obvious, it's textbook, it's very simple, it's very basic. Now that price has stopped, we can apply a fib to get a longer term target. So let's now scale back out so that we can see this a little bit more clearly. Right, okay, so here's the 4 hour. Now as you can see, if we had waited for this 4 hour to close, our entry would have been here. Therefore, that would mean that our stops would have to be a lot bigger. But because we scaled down into an area of interest, it allowed us to get a much better entry and much tighter stops. Now, it's not rocket science. We know that for this particular trade, we are looking to come down to this level here. This is the area that we're looking to come down to, okay? We're looking to come back down to this upper channel, this ascending trend line, and one of our fib levels. We know that that's very likely because this is how price has been playing for the last sort of few months. So this is a very, highly probable trade, and it's a very good risk to reward because we know that this line's been respected. We know that this area is the minus 27%, and then we've produced a bearish engulfing candlestick on the hourly and this 4 hour. Now, actually, in fact, on the daily, we also produced what looked like almost a shooting star / sort of spinning top, which was the first sort of red daily candle since down here, really. So that would have been a sign then to actually wait for that daily close and then get in on the next day. But to be honest with you, we didn't want to wait that long. We knew this was already an area of interest. We'd scouted it out way before this had already happened. So therefore, when price was approaching it, we would have just simply been zoning in on the 1 hour and the 4 hour to look for those kind of rejections. So this would have been our next trade. Now, there's a few other opportunities as well on the way down to trade this. So I'm going to show you that as well. But I'm first going to show you how this actually planned out. So this is where we kind of moved sideways a little bit. Now, to be honest with you, our target was hit here. But this wasn't really our target. Our target was more here. Yeah, it's just a risk to reward tool. It's more further down here as such. So it's kind of between a 4 and a 5 risk to reward. But it's hard to do the risk to reward tool when it's at a slant like this. But anyway, nevertheless, our target was hit. Now, as you can see, we actually broke this trend line, but we're going to get onto that bit just in a minute. So that would have been another 1 to 4.5. So we'd be risking 50 pips to gain 235 pips, 230 pips, something like that. Now, I'm going to show you that within this bit of price action, what you could have done if you had missed this first initial trade and how you could have actually found more opportunities within this to actually get back into the trade. So I'm just going to scale back down to the 1 hour so I can show you this. Okay, so this is the hourly time frame. So let's say we missed this trade. Okay, because we weren't watching it or whatever, but we could quite clearly see that gold was overstretched and was looking to come down to the next part of the trend line. Where could we have got into this particular trade next? Well, what we can simply do is we would have been able to box this off here. And when we had this break and then this retest, once price stopped, we could do an hour fib within a fib. And we can see that price came up to tap previous support resistance and the 50%. Create this doji candle and another one here, which is almost like a miniature spinning top. So we could have got in on any one of these and ensured that our stops were basically, so we got in here, ensure our stops are something like that. Okay, 25 pips. And again, the overall target would be still over here, our area of interest that we're looking for price to respect. Something like that, okay? Which would have given us, let's have a look at what the risk to reward. That would be a 1 to 8. Now, it's a much better risk to reward than up here. Why? Because the stop loss is less. The stop loss is a lot less, okay? So what I'm trying to say is that don't worry too much if you've missed a trade. There's plenty of opportunities to getting on the move down. Now, sometimes what happens is if people miss this, or if they take this first entry and then get stopped out, they just give up. And they just say, do you know what, I'm not going to bother again. But that's when you shouldn't give up. Technically, this has multiple confidences to sell, okay? We've already predetermined that before price even got here. So therefore, if it takes us out and spikes back up, or for whatever reason, as long as it's still looking technically what we think it is, there's absolutely no reason whatsoever to not get back into this trade. So therefore, if you'd missed this, or say for example, price had spiked up, then this would be your next opportunity to get in. Now, you could have also got in here, because you've got 1 tap, 2 tap. So therefore, we could have got in on our second tap and used our first tap as benchmarks for stops. Something like a 45 pip stop just to clear that first part of price. Something like that. And again, target would be exactly the same. There'd be no reason to close this trade. We know that gold is very much moving in equal movement, so this would be your first one. Now, that's a 1 to 8. It's a beautiful trade. Now, if you'd missed this one, where would you next get in? Simple. We know that gold likes market structure. We'd simply place a fib within a fib. So say we'd go from here down to here. Now the reason why you'd go from here is because you had this range here, this green candle, and then you came up and flicked up, and this was almost like your last point here to go from. So therefore, I mean, to be honest, whether you went from there or there, it's pretty much accurate, but this is where I would go from personally. We came up, flicked the previous resistance. We also hit the 1 hour 50 EMA and the 61.8. So therefore, you could have gone short off here. And again, as long as your stops were above. So to be safe, I probably would have done something like a 35 pip stop. And again, target is exactly the same. Now this probably would have been the last trade that I did on this particular pair. Because now we're approaching the overall target. The risk to reward is going to minimise dramatically. But there is one more place where you could have taken a trade. Okay, so that's the 2 scalings that you could have done. So you've got one entry of the bearish engulfing. Second entry where you can see that we've rejected it twice. Therefore, you can use the first tap. And you've got these candlesticks that are suggesting the price is being respected once more. The third time you could get in is here, off this doji indecision retest of the broken zone on the hourly. And obviously you've got the 50% level that we marked on previously. The next way you can get in again is another break retest, 1 hour 50 EMA, 61.8% being respected. So therefore you could have got in off this candlestick closure to wait for it to close to prove to you that this is what was happening. And then the next opportunity that you could have probably got in on this particular trade would be, because we are forming lower highs, you could have basically applied a trend line once you've got 0.1 and 0.2, dragged it out like this, and then when price came down to form this new lower low on sort of the hourly 4 hour, once price had stopped, you could have flipped it from here to here, and you could have basically got in short of this candlestick closure here, but it stopped sort of 35 pips above. Let's see how that fits. Something like that, maybe even 40 pips. And this would have actually been your signal to take this a lot lower. Now, I know that you're getting a bit confused because you're thinking to yourself, well, this is your target though. This is where you're looking to buy it. Now, let's just rewind just a minute and let's zoom back out to the 4 hour. Now, when I started seeing this, let me just remove this fib. When I started seeing this price action, I was anticipating for gold to actually break this trend line once and for all. Why was I anticipating that? Okay, well, I'll show you. Not only was I creating lower lows and lower highs on the 4 hour, what happened here, when we approached the 61.8, retail traders were buying this. This is why price came up. And they had a great morning. You know, they bought it from 13.18 up to sort of 13.24, which is 60 pips. And then it rolled over. Now, I knew it was going to roll over because we were creating these new lower lows and lower highs in the 4 hours. So therefore, I fibbed it and I could see that we closed below the 78.6, which is the last point of validation. Now, if we close above the 78.6 here, then I would expect price to then, flick back up almost. But it didn't. It bounced off here, it came up, and then it rolled over. So I used that 78.6 from here to here to determine that price was not going to go much further once it did bounce off the 61.8. So that was my alarm bell signal. Now I actually used silver as well for a correlation for this. And I'm going to show you exactly what happened with silver afterwards, once we've gone through this chart together, and show you how I could have used silver to actually tell me that this was going to happen, tell me that this was going to happen, this was going to happen, and almost predict the future for gold to help me. Now, when it broke, and obviously I was in this, if you were in this particular trade here on that retrace, you'd have target 1, target 2, and if you were lucky, you would have probably held it all the way down. Alright? Now, if we're talking about this, I didn't really touch gold at all until it figured out what it was doing. I had to wait for gold to basically stop. I had to wait for it to stop. Because obviously I can't really do anything until it stopped. So therefore, when it did make its mind up, let's just zoom back up the daily. Now when price did finally stop, from this point here, all the way down to here, I can simply apply my fib tool. The first thing we're doing, price finally finds a bottom. Now you can quite clearly see, it's not rocket science, that gold was destined to come up and create a new lower high. Why was it destined to come up and create a new lower high? Simple, because at this point here when it rolled over, it took out the most recent higher low. So when it done that and then it formed this new lower low, we realised that we were in a sequence where we were going to carry on to become bearish once we'd broken this main ascending trend line and we'd taken out this this recent higher low. So therefore, instantly, when price stops, I apply a fib. I'm anticipating for price to come up and create a lower high. Now I don't know where that's going to be, right? When I'm looking at this, I'm not sure where it's going to be. But like I've taught you guys in market rules, we have to assess each fib level to determine where price is likely to go. Now, when I'm looking at this, me personally, I wouldn't think we were going to come to the 50% or the 38.2. It's actually very likely on this particular scenario that we're probably going to come to the 61.8 because we have previous market structure here. So this has got 2 levels of confluence. This has got 1, 1, and 1, just being a fib, whereas this has got 2. So trading is a game of probabilities, okay? And we have to use what we have in front of us. Now I can quite clearly see that the 61.8 has more confluences. So at the moment it begins doing this, let's now drop down to the 4 hour and see what else we could have done here. Okay, so this is now the 1 hour, and we can see that, sorry, it's the 4 hour. We can see that basically what we've done here is we've formed this base which has allowed us to draw our trend, our fib tool. And now we can quite clearly see that we have an area of interest around this level. So there's not really much point in doing anything now until price begins to approach that highlighted area of interest. There's no real need to trade this. Let's just clean this up a little bit. Now, once I've got point 1 and point 2, the first thing that I can do is draw a trend line. So this would be something like that. And I would now be waiting patiently for price to break these levels and hopefully start coming up to this level so I can begin looking for some shorts. Now, as you can see, we broke the trend line here, but we did not take out previous market structure. Okay, we didn't take out previous market structure. As we know, trend lines are very subjective, so therefore I would have to tighten up my trend line like this. Unless it completely breaks it and breaks market structure, that's only really when I'm interested. So this is my protection line. Bounce off the 450, right? Nice. Okay, so this is when we're now approaching the level. Here we go. Right, we've tapped now the 61.8. The 61.8 has now been tapped, and we've basically formed on the 4 hour this spinning top. So to be quite honest with you, you probably could have just come straight off this spinning top here and put your stops sort of 45 pips above. something like that. And your first target would be 0%, just in case we create this double bottom. So that gives you a 1 to 9. But obviously, really what you're doing is you're anticipating, fingers crossed, an actual much lower target than that. A much lower target. But this, I mean, you know, this is a 395 pip trade. It's a lovely trade. Personally, I'd be actually very happy with that. But if you're that way in mind and you quite like swing trading things, then, you know, you could have had this a lot longer. Now, let's scale down to the 1 hour and see if we could have got an even better entry once we'd highlighted this, because we know that this is our highlighted area of interest, right? Around this kind of level here. Now, once we approach, some people could have got in here a little bit earlier. And if you hadn't have allowed yourself enough of a stop, you probably would have got stopped out maybe. Let's have a quick look. So people had have gone short here and given themselves maybe a 50 pip stop. Yeah, you probably would have got stopped down the first go if you'd got in here. But, you know, we didn't really tap the 61.8 as such. At this point, this was a beautiful tap. Beautiful entry. So let's go down to the 1 hour and see if we could have got a better entry on there. Okay, so this is now the 1 hour. Let's have a quick look. To be honest, you probably couldn't have got much of a better entry on this. It'd be a similar kind of entry. Somewhere around here like this. Now, if we were looking at this, the next place that you could have got into this is if you missed it, because again, it's the same thing with most people. Is once they've missed this, they start getting worried that they can't get back into it now because it's not going to be worth it for them. So therefore, simply once we've broken this trend line here, we would look for price to stop and we would apply a fib. Okay, now we can quite clearly see that on this smaller fib within a fib, the larger fib, we broke and we came up to the 38.2. And we also knew that we weren't probably going to go past 50% at this point because we had the 1 hour 50 EMA, which was providing us some dynamic resistance. So you simply could have gone short straight off this candlestick here, which is a bearish engulfing candlestick, and ensured that your stops were above the moving average to offer you some sort of resistance to this particular trade. So that could have been your next entry of this. And again, targets would be the same. You'd be targeting the overall 0%. So let's just scale out so we can see that. So the 0% is down here. I'll show you guys quickly. This is the larger fib. So we target the 0% just in case we created a double bottom. So that's another 1 to 7.69. And then obviously our first trade was here. I think we allowed ourselves, I think it was 35 pips. And again, this would be a trade down to the 0% as well. That was a 1 to 12. Just off market structure, the fact that we created the new lower lows, we're now in a bearish sequence, we're anticipating a new lower high. We met this at 618 and previous market structure on the 1322 level. And we created these candlestick formations within the area of interest. That was our first shot. Our second shot would have been a break and almost such of like a retest. And we can almost see actually not only do we have the 1 hour 50 EMA here, we actually have the 4 hour 50 EMA as well, which is also providing us some dynamic resistance. That was a great entry. That was your second one. Now there's one more entry you could have got in on this, which wasn't the best entry, but I'll show you guys where it was. Let's scale down to the 1 hour. Okay, so the next entry you could have got on this would have been at this point here. Not the best entry really, to be honest. But basically, if you'd fibbed it from here, which is again another fib within a fib, to here, you could have seen that price tap the 50% and the 1 hour 50 EMA and the round psychological number of 1300. Okay, so that could have been another possible entry to go short here. I don't know whether the risk to reward is any good on this particular trade. Oh, that's not so bad at all. A 1 to 2. So if we put our stops at 50 pips, something like that, then that could have been a fantastic trade to basically come off this bearish engulfing candlestick, which again, like I said, is the 1 hour 50 EMA, the 50% of the fib within the fib, and the 1300 round psychological number. I actually took all of these trades. I took this trade, this trade, and this trade, hence why I'm breaking it down so easily for you guys. So therefore you would have hit target here. Okay, so we hit target on all these trades, the 0%. Beautiful trade. So that was, let's have a quick look at this. So this was 405 pips. This was 143 pips. And this was nearly 300 pips. So if we say really, to be honest with you, that's 450, sort of 850 pips, something like that. And this happened in the space of 2 trading weeks. 850 pips, it's massive. I mean, you know, if you did 1%, I mean, that's what, 7% there, nearly 3%, 10%. So that's nearly 22% over 3 trades in 2 trading weeks. Very light work, just based off structure, fibs, and moving averages. Now let's take this away. Take this away. Just neaten things up a little bit. Take away these fibs. And we'll take away this. Now, what happened was, let's just scale back out again. Okay, so what happened was, is now that we've got these 2 points here, and this was obviously 61.8 from here to here, we can now draw a trend line because we've got 2 points. Okay, that's all we need. Something like this. Okay, now we were anticipating that once this broke, we'd come down to here. That was the goal for us, because obviously this is market structure and it lines up beautifully with the minus 27%. But unfortunately that didn't happen. What actually happened is we came down, we did form this double bottom. So it's a good job that we did take off a large percentage of our position at this point. Now what happened next was, because price had stopped, once more, we could apply another fib. Now when I'm looking at this, I'm thinking to myself that probably price is going to come up to here, something like that, for some more shorts. And maybe this is what we need to actually take this lower. So I'll be expecting price to come up to something like this, and then collapse. Okay, that's what the kind of thing that I was expecting when price stopped and began to build a base. So let's see how price played out. Okay, so we're now coming into our favorite area of interest. The first thing that we do is we scale down. So now let's scale down to the 1 hour. Okay, so we're approaching our area of interest, which is 61.8% and the third touch of a descending trend line. So we could also maybe do something like this, where we draw a counter trend line. Maybe something like that. It's only a counter trend line, it's not the neatest. Let's press play and let's see if we could have found an entry on this. Okay, so for me personally, watching this play out, where would have I entered on this? I probably would have entered on any of these candlesticks, which show a massive move in slowdown in momentum, or alternatively, I would have come straight in off this spinning top around the area of interest, and it would have again allowed enough space above to allow for any kind of other potential spikes around this area. And for me, as always, the target is always 0% first. And once we've hit 0%, I'd then be looking to take this a lot lower. Okay, let's play this one out. So as you can see, we hit target beautifully. So that was another 1 to 8. So that could have been potentially another sort of 8% in your account. So in total, that would have been around 30% in your account over some very, very, very simple trades over the last sort of few weeks. Now, I also want to now just zoom out and show you how silver was reacting at all these points. So then we're going to flick through the different tabs, both silver and gold, and we could have seen how silver could have helped us with some of these trades. Okay, so as we can see, this is obviously the zoomed out version of the daily chart on the gold. We can simply see how easy this was for us to place these trades. And now, even to be honest with you, something else we can do is simply duplicate this and put this almost back in a channel. So now we can actually get a target for where basically we think gold is going to go next. So it's very basic gold to trade. Now, I'm going to now flip over to silver and plot some levels on silver, and we'll see how they relate on the points that we were sold. So I'm just going to highlight the areas that we either bought and sold this. I'll change this back to a brighter colour. So we bought it here, okay? We sold it around this level here, and then we were obviously selling it on the way down too. We sold it here, and we sold it here. But obviously I know there's other opportunities as well, like for example the break here, the trend line, etc. And we also bought it here as well in this third touch in 78.6 and market structure. Okay, now let's have a look at silver and see how silver relates so well. Okay, so this is the silver chart. Now it's one of those ones which very much sticks to levels. Now we're back again around the sort of beginning of November, so a similar time to here on gold. So let's just plot some levels and see how well price respects these levels. So for me personally, I would first be going in at around maybe somewhere like here, because we've got these 2 points here, you see. Can you see this? Let's just have a look at this quick and zoom in. We've got these 2 points here, okay? So let's just get this nice and tight. So I probably would have done this at 14.75, something like that, because then we can see that we're respecting it here as well. So that would be my first level. Now my next level for this pair would be probably off this wick here. So maybe 15.20. My next point would be probably this point here, maybe. Let's have a look at this. Somewhere between here, because we've got this point, this point, and this point. So maybe something like 15.75. And then my next level would be maybe somewhere around here, this wick here, and this wick here. So maybe 16.20. Cool, because that's really well respected here. So 16.20 is a lovely, lovely strong level. Now let's watch happen with. Let's see what happened with silver, and then once silver's done its cycle, we can then see how this correlated so well with gold. Okay, again, it's another example of where we've basically came up to this level here, the 15.75, respected it, came back down, formed this, if you look at this, these two candlesticks suggest that this level is being respected, and then we continued. And then we came up, hit 16.20, came down, tested, at this point here, I probably would have put in a trend line to see if this would break. Something like that. Okay, we broke that resistance. Okay, we've got 2 points again. Maybe we could put a trend line here. Let's have a look. Maybe not. It's quite a slanted trend line. Let's see how that looks. Might break through it. Okay. I don't know. It's respecting it very well. So this is where we now are. Now, actually, I can see already that this is beginning to look a little bit like something like this. You see this? Something like a falling wedge. So therefore, I'd now be looking for this to come further down, maybe to 14.75, which is the next market structure. Okay, but let's have a look at this. Let's just take this away for a second, and let's have a look at what happened. So, what happened on the 21st of January with gold? Okay, the 21st of January, we were here. Now, a lot of people at this particular time here were thinking that this was going to break and roll over and come back down to sort of 12.40. Now, on the 21st of January, we formed this, almost this spinning top, this indecision candle to say price was not sure what it was going to do next. But to give us extra confirmation, we go to silver and we can see it's rejecting a key level. Now, gold is not rejecting a key level. It's actually in no man's land right now. Although it is close to touching this ascending trend line, that's the only real confidence that gold has. But silver, on the other hand, is touching a very, very important level. So the next day, on the 22nd of January, which for gold was this day here, people still weren't so convinced on this. People were still thinking this may roll over. People were thinking this could have been a retrace to then go and drop. But we knew, just from looking at silver, that wasn't the case, that gold was about to fly. Because if silver was about to fly up again to the next structure of support, we already knew that gold was going to take off. So we could have used this as a little bit of an extra confidence to let us know that this was what was going to happen next. Now let's look at what happened next. So gold did fly up. Actually came right up. Now when gold met here at the 31st of January, what was silver doing? Well, look, on the 31st of January, silver was hitting a key level. Okay, so we would have known on the 30th of January, which was this day here, that because silver was approaching a very strong key level, that gold was probably going to reject around this level too. So that could have given us another confidence that gold probably was not going to go much further than this on this occasion. Now, I knew we had other confidences anyway. This was on minus 27%. But what I'm trying to get through to you guys is that we can use silver because silver will let us know, depending on whether it's at the right key level, on what gold's going to do next. Now, gold did sell off from here on the 31st of January, and so did silver. Now, silver then came down to this point here. And gold, obviously, came down to this point here. Now, gold then stopped on the 14th of February. What did silver do? Silver did the same thing. Silver stopped too. Now, gold then came back up to the next point, which is, like I said to you before, the minus 27%, right? So therefore, when gold was approaching this area, silver was approaching the 1620 once more. Now, we already knew that silver couldn't break through it this time, so it's probably not going to break through it again. This is obviously a very strong level of resistance because it was previous support. So therefore, from just looking at this on the 20th of February, we would have known that gold was coming down because silver looked like it was going to come down, so gold was going to come down too. So that could have given us another little bit of a helping hand on deciding whether to sell this. Now, when gold broke this trend line on the 28th of February, what was silver doing? Silver, on the exact same day, had broken this trend line. See, 28th of February, broken this trend line. Now, we knew for a fact that when it broke this, it was probably going to come down to the next market structure. So therefore, when this broke this was not a fake out. This was going to sell off. We knew that just by looking at silver. Okay, so that's that. So then we stopped. We stopped on around the sort of the 6th of March. What did silver do? Silver stopped around the 6th, 7th of March too. Now, when silver was coming up like this, we could have done the exact thing that what we did to gold. We're also anticipating for silver to come up to one of these levels. Now, in this particular scenario, we probably would have expected silver to actually come up to this 1.8, but it didn't make it that far. It only made it to 50%. And gold made it to 61.8%. Which was from here to here. Okay, so when gold started approaching here, gold only gave us 2 daily rejections. Silver gave us 1, 2, 3, 4. So literally on the 21st of March, which was days before gold was here. Okay, so what I'm trying to say is that silver already told us that it was going to sell off. We just had to wait for gold to do it shortly afterwards. Silver told us 4 days before, and then gold finally made the move at 61.8. Okay, so what I'm trying to say is that silver normally happens before, and then gold follows suit. So then gold started off at the 61.8. Came down and stalled again on the 4th of April. What was silver doing? On the 4th of April, it's also forming a double bottom. Now, because I've got 2 points here, I can draw a trend line. Just tighten this up. I can draw a trend line. Now, silver 1, 2, and 3. I'm anticipating a third touch. Price stops and forms this double bottom. So the first thing I'm going to do is attach a fib. Now, I could see on the 9th of April, which was here, again, silver provided us the signal the day earlier, that basically, as long as silver could stay below this sort of 50, 61%, and the 50 EMA, and the third touch of the descending trend line, the gold was shortly going to sell off too. So silver gave us that signal on the 9th of April, and gold was here. Gold was here. So silver was helping us by letting us know that if silver's going to fold over, gold's going to fold over too. And then the next day was a doji, and then the following day was a massive sell-off. Next day was the last push, and then the following day was a massive sell-off. So what I'm trying to say to you guys is that back test this correlation, please, because I'm not going to go down into it on a 4 hour, but there's many, many opportunities of why I sold this and why I get some of the entries that I get on Instagram. It's simply because I'm using silver to help me with a little bit of direction by just plotting certain levels on silver, which really massively helps me with gold. Okay, so obviously it's obvious that gold and silver correlated. You know, it doesn't take a brain scientist to work that one out. But what I'm trying to say is that get your key levels right on silver, and then know that silver trades between those levels. And if it's not yet reached the level, gold will have a little bit further to go. So you can almost use that as a correlation. I hope this video has been helpful. It's one of those videos where I haven't really given away like all these little secrets and stuff. Only simply because gold's just really simple, guys. It's as simple as that. It really is, honestly. It sticks to levels. It sticks to structure. It's a very, very simple pair to trade. I mean, you can see how simple this was. We plotted all these lines from previous market structure, and every single line it responded to. Okay, so I hope you guys have found this helpful. It's one of the simpler ones, and I'd be really, really interested to hear your feedback on this particular video. Thank you guys, I'll speak to you soon, and the next video will be another market breakdown.